Gold is everywhere. Every financial channel talks about it like it's the final refuge. Bitcoin gets even more attention. Price charts, breaking news, predictions every single day. You can't open your phone without someone telling you where money is moving next. And that alone should make you pause for a second. Because whenever everyone is looking in the same direction, history shows that the real problem, or the real dependency, is usually somewhere else. Think about your phone for a moment. Not the brand, not how much you paid for it, just the fact that it works at all. That electricity moves cleanly through microscopic paths, hour after hour, without failing. Or think about how quickly everything stops when the power goes out. No signals, no payments, no navigation, no control. We live in a world that feels digital, weightless, almost abstract. But under that illusion, everything still depends on very physical things. Materials, atoms, metals that don't trend on social media and don't make headlines. Gold is stored, Bitcoin is debated, but there is another metal that is quietly being used up every single day, inside your phone, inside power grids, inside technologies we now consider normal, and almost nobody is paying attention to it. The uncomfortable question isn't whether this metal is important. The real question is why it's missing from the conversation entirely, and what happens if it's not there when we need it. For a long time, silver has carried an unfortunate label: the poor man's gold. At first glance, that description sounds harmless, almost logical. Gold is expensive, silver is cheaper, so people assume one is important and the other is secondary. But that label didn't appear by accident, and it says more about perception than reality. Historically, silver was everyday money. It was what people actually used, in trade, wages, and savings, while gold stayed concentrated among governments and elites. When currencies moved away from metal-backed systems, silver slowly disappeared from daily life. Not because it stopped being useful, but because it became invisible. And what people don't see regularly, they stop respecting. There's also a media problem. Attention follows drama. Bitcoin moves fast, so it dominates headlines. Gold feels prestigious, so it gets framed as serious. Silver does neither. It doesn't crash spectacularly, and it doesn't signal status, so it quietly falls out of focus, even as its real-world role grows. Psychology plays a bigger role than most people realize. When something is cheap, the brain instinctively labels it as unimportant. We do this with products, with time, even with information. Silver suffers from the same bias. Its price makes people assume it's abundant or replaceable, without ever asking why it's priced that way in the first place. The result is a collective blind spot. People don't reject silver. They simply don't think about it. And history shows that the most dangerous risks are rarely the ones everyone is talking about. This is the point where most comparisons quietly fall apart. Gold and silver are often mentioned in the same sentence, as if they play the same role with different price tags. But once you slow down and actually look at how they exist in the real world, you realize they behave in completely opposite ways. Gold is stored, silver is used. That difference sounds small until you follow it to its logical end. Gold spends most of its life sitting still, in vaults, bars, reserves. When gold is used in electronics, it's usually thick enough and valuable enough to be recovered. It comes back into the system. Very little gold truly disappears. Silver doesn't get that luxury. In modern electronics, silver isn't visible. It's spread in microscopic layers, bonded into solders, printed onto circuits. It's there to make sure electricity flows smoothly, heat dissipates properly, and signals don't fail. Once silver is used this way, recovering it often costs more than the metal itself is worth. Think about a cheap charger that stops working after a few months. The cable overheats, the connection weakens, the internal pathways degrade. Engineers fight those problems with better materials, and silver is one of the most effective tools they have. Not because it's rare or beautiful, but because it performs. This is where the comparison with gold breaks down completely. Gold can wait, silver cannot. Gold accumulates over time. Silver slowly bleeds out of the system, device by device, circuit by circuit. So when people look at silver's price and assume it reflects abundance, they're missing something crucial. The price doesn't show how much silver exists underground. It shows how much silver survives above ground after decades of being consumed. And once you see that difference clearly, it becomes much harder to treat silver like cheap gold. It's not a weaker version of the same thing. It's a fundamentally different asset, governed by use, not storage. Most people hear the word technology and imagine something abstract. Software, apps, clouds, data. But technology doesn't live in the cloud. It lives in hardware. And hardware lives or dies by the materials inside it. Take your smartphone again, but this time think a little deeper. Every tap, every swipe, every signal depends on electricity moving through extremely small, extremely precise pathways. At that scale, resistance matters, heat matters, failure margins become tiny. This is exactly where silver enters the picture. Silver is used in contacts, switches, and circuit paths because it carries electricity more efficiently than any other metal. That efficiency isn't about speed, it's about reliability. Less resistance means less heat. Less heat means longer life. That's why cheap electronics fail faster. Manufacturers cut material quality where you can't see it. The same logic applies to solar panels. Each panel uses silver in its photovoltaic cells because sunlight has to be converted into usable electricity with minimal loss. Engineers don't choose silver because it's fashionable. They choose it because alternatives underperform. Replace silver with copper and efficiency drops. Replace it with aluminum and durability suffers. Electric vehicles push this even further. An EV contains significantly more silver than a traditional car, not for decoration, but for power management, safety systems, and control units. As vehicles become more autonomous and energy dense, the reliance on high-performance conductors increases, not decreases. People often assume technology will simply adapt if a material becomes scarce. But substitution isn't magic. Every replacement comes with trade-offs: higher heat, higher failure rates, lower efficiency. At some point, those trade-offs stop being acceptable. This is the uncomfortable truth. Modern technology doesn't just use silver, it is designed around it. Remove silver and the systems don't gradually weaken. They start breaking in ways that are hard to predict and expensive to fix. At this point, a reasonable question usually comes up. If silver is so important, why don't producers just mine more of it? On the surface, that sounds logical. Higher demand should lead to higher supply. That's how most markets work. Silver is different. The first problem is that silver is rarely mined for silver itself. The majority of global silver production comes as a byproduct of mining other metals, mainly copper, lead, and zinc. That means silver supply depends on decisions made for completely different markets. Even if silver prices rise sharply, miners won't automatically increase silver output unless it makes sense for those primary metals. Then there's time. Opening a new mine isn't like building a factory. From discovery to production can take a decade or more. Environmental approvals, infrastructure, financing, and geological uncertainty slow everything down. By the time new supply arrives, demand has usually moved on again. There's also the issue of ore quality. Over time, miners extract the highest grade deposits first. What's left is harder to process and yields less metal per ton of rock. That means more energy, more cost, and slower growth, even when prices are favorable. This creates a frustrating reality. Silver supply doesn't respond quickly, or sometimes at all, to rising demand. The system isn't broken, it's simply rigid. So when people assume higher prices will magically solve shortages, they're applying the logic of flexible markets to a resource that doesn't behave that way. Silver production moves slowly, cautiously, and often reluctantly, while industrial demand keeps accelerating. That imbalance doesn't announce itself loudly. It builds quietly, year after year, until the gap becomes impossible to ignore. At some point, almost everyone reaches the same conclusion. If silver becomes scarce, we'll just recycle it. It sounds reassuring, logical, responsible. And on paper, it makes perfect sense. In reality, recycling silver is far more complicated than people imagine. The problem isn't willingness, it's scale and structure. Modern electronics contain silver in extremely small amounts, spread across complex components. A smartphone might hold just fractions of a gram, bonded into layers that were never designed to be separated again. Extracting that silver requires chemicals, energy, and labor that often cost more than the recovered metal is worth. This is why recycling works well for things like aluminum cans, but struggles with circuit boards. The material is there, but it's dispersed, contaminated, and difficult to isolate. From a business perspective, most recycling operations focus on what's easiest to recover, not what's most critical. There's also a timing issue. Recycling responds slowly. Devices need to be collected, sorted, dismantled, and processed. That takes years, not months. Meanwhile, industry consumes fresh silver continuously at a pace recycling can't match. So while recycling helps at the margins, it doesn't reverse the trend. It doesn't refill inventories, it doesn't replace primary supply, it simply slows the decline slightly. The illusion is believing recycling is a safety net. In practice, it's more like a brake. Useful, but nowhere near strong enough to stop the system from moving forward. When most people check the price of silver, they assume they're looking at the metal itself. In reality, they're looking at a promise, a contract that represents silver not necessarily silver that exists in a vault ready to be delivered. This distinction sounds technical, but it matters more than people realize. Paper silver exists because it makes markets liquid. Futures contracts, ETFs, and other instruments allow companies and investors to hedge risk without moving tons of metal around the world. As long as most participants are satisfied settling in cash, the system works smoothly. The tension appears when too many people want the same thing at the same time. Physical delivery. Think of it like airline tickets. Airlines sell more tickets than seats because they know most passengers won't show up. That model works until everyone arrives at the gate. At that point, the problem isn't fraud, it's math. Silver markets operate under a similar assumption. For decades, it was safe to believe that only a small fraction of holders would ever request real metal. Industrial users, governments, and long-term buyers are now testing that assumption. Delivery doesn't fail overnight. It becomes slower. Premiums rise. Settlement terms get more complex. None of this makes headlines, but it changes behavior quietly. Some buyers insist on physical metal. Others accept paper exposure, but at a growing discount to reality. This doesn't mean the system is fake. It means it was designed for efficiency, not stress. And when stress builds, systems reveal their limits. Not dramatically, but through friction. The important point is this. Paper prices can stay calm even while physical supply tightens. The disconnect doesn't scream, it whispers. And by the time it becomes obvious, the adjustment is usually already underway. Whenever discussions about silver reach this point, someone eventually brings up 1980, the Hunt brothers, and what became known as Silver Thursday. It's often presented as a cautionary tale, but usually in an oversimplified way. The Hunt brothers believed paper currency was losing credibility, and they tried to protect themselves by accumulating physical silver and futures contracts. As prices rose sharply, the market structure came under stress. Exchanges responded by changing trading rules, limiting buying, and increasing margin requirements. Prices collapsed soon after. At first glance, the lesson seems obvious. Don't fight the system. But that's not the whole story. What actually failed wasn't silver as a material. It was leverage and concentration. A small number of players tried to control too much of the market too quickly. When rules changed, they had no flexibility. The more important lesson is subtler. Markets are not neutral. When pressure becomes intense, the rules can change to preserve stability, even if it hurts individual participants. That doesn't mean manipulation is everywhere, but it does mean risk isn't always symmetrical. The situation today is different. Demand isn't concentrated in a single group. It's spread across industries, governments, and millions of buyers who simply need silver to function. You can regulate speculation, but you can't regulate necessity. History doesn't repeat itself exactly, but it does show how systems behave under stress and what breaks first when assumptions fail. What makes this period different isn't panic or speculation. It's timing. Over the last few years, several long-term trends have started overlapping. Energy systems are changing. Governments are pushing toward electrification, renewable power, and data-heavy infrastructure. All of those shifts increase reliance on materials that move electricity efficiently and reliably, not occasionally, but constantly. At the same time, silver is quietly moving into a category policymakers rarely talk about openly: strategic metals. These aren't luxury commodities. They're materials that national systems depend on, from power grids to defense technology. When something reaches that status, markets stop behaving like free playgrounds and start behaving like controlled environments. Defense demand adds another layer. Modern surveillance, communication, and precision systems are silver-intensive by design. This isn't optional consumption. It's built into long-term budgets that don't disappear during downturns. What's striking is how little of this enters public conversation. Governments don't highlight dependencies they can't easily fix. Industries don't advertise supply vulnerabilities. Silence becomes a form of risk management. So when people ask why silver feels suddenly relevant, the answer isn't hype. It's convergence. Multiple systems are leaning on the same material at the same time, while supply remains slow and inflexible. Moments like this don't last forever. They either resolve quietly or force uncomfortable adjustments. Which path we're on depends less on opinions and more on physical reality. Before closing this conversation, it's important to be clear about what this video is not. This isn't an investment pitch. It's not a call to buy anything, and it's definitely not a promise of easy gains. Those kinds of stories are loud, emotional, and short-lived. What this is about is understanding dependency. Silver isn't special because it's shiny or historic. It's special because modern systems quietly rely on it while pretending they don't. Electricity, energy storage, communication, and defense all lean on the same physical material, even as the world talks more and more about digital solutions. That creates an uncomfortable gap between perception and reality. You don't need to believe in collapse scenarios to see the risk. You only need to accept that physical systems have limits, and those limits don't care about narratives, opinions, or market confidence. They respond to availability, performance, and time. Silver sits in a strange position because it doesn't ask for attention, it just gets used over and over until one day something feels tighter than it should. What you do with that understanding is entirely your choice. Some people ignore it, others watch quietly. A few prepare in ways that make sense to them. The important part isn't urgency, it's awareness. Because the real trap isn't silver, it's assuming that systems this complex can change direction instantly, without friction, without cost, and without consequences.